Have you ever stopped to think about the companies that are, well, absolutely indispensable to how science and medicine actually happen? The ones whose names might not be on your everyday stuff, but without them, those breakthroughs we read about, they just wouldn't happen. They're kind of the silent architects, quietly helping make the world healthier, cleaner, and safer, even when things get pretty complex out there. Today, we're going to pull back the curtain on one of these titans, Thermo Fisher Scientific, TMO for short. And forget thinking of them as just some supplier. TMO is really the classic picks and shovels provider for the entire life sciences and healthcare world. They equip basically every single stage, discovery, development, manufacturing, you name it. So our mission today is to really get our heads around how a company this massive not only navigated that huge boom during the pandemic, but also how it handles the tricky transitions that come after. We'll look at its unique business model, its really commanding market position, its financial journey, which has been fascinating lately, and what it all means for where they're headed next, especially now the world's kind of moving beyond the immediate pandemic shadow.
Yeah, and what's truly eliminating about Thermo Fisher, I think, is that it's so much more than just a big company. It's a preeminent wide-moat enterprise. Its story is almost like a masterclass in how a leader becomes so deeply embedded in critical sectors that, well, they basically become indispensable. So by understanding TMO, you're not just getting insight into one company, you're really grasping the underlying mechanics of the whole health and research sector. How they function, what drives the innovation, where the frontiers are actually being pushed. Our goal here is to cut through all the complexity, the jargon, the sheer amount of data, and deliver those crucial insights, really help you understand this company's formidable presence and the specific challenges and opportunities they face right now. It's about seeing the gears of scientific progress through the lens of this one very powerful company.
That's a perfect frame for this. So let's start by painting a picture of TMO's sheer scale and its core purpose. When we talk about Thermo Fisher Scientific, we are genuinely talking about the world's largest provider of life sciences tools and services. It's huge. Their annual revenues aren't just over $40 billion. I mean, they hit $44.1 billion over the last 12 months as of Q2 2025.
That's staggering, right?
Absolutely staggering.
And their mission statement, to enable our customers to make the world healthier, cleaner, and safer, it's not just corporate speak. It feels like it really captures their impact. But here's the really interesting part, I think. How does a company this big manage to be so essential across such a diverse customer base? We're talking everyone from the biggest pharma giants working on new cures all the way down to like a small university lab researching some rare disease. How do they do that? That question gets right to the heart of their strength, doesn't it? It's their breadth and their depth. When we use that picks and shovels analogy for life sciences, it means Thermo Fisher isn't the one mining the gold. They're providing every single tool the miner could possibly need. So the advanced picks, the specialized shovels, the carts, the safety gear, even the whole infrastructure for the mining operation. They aren't necessarily making the specific drug discovery or developing the therapy themselves, but they are absolutely indispensable to the people who are. They provide all the essential infrastructure, the cutting-edge instruments, the highly specialized chemicals, the reagents, the critical services, everything that enables that whole life cycle, discovery, development, manufacturing. And they manage this incredible reach through a really well-structured, highly synergistic ecosystem. It's built on 4 complementary business segments. And it's not just, a random collection of businesses. Each piece is designed to enhance and support the others. It creates this powerful, integrated whole.
Okay, let's start with Laboratory Products and Biopharma Services, LPBS.
You can kind of think of this as the logistical and service backbone for the entire scientific community. In Q2 2025, this segment brought in a massive 55% of their total revenue. Huge chunk. Inside LPBS, you've got Fisher Scientific, which is basically like the Amazon or maybe the ultimate Costco for lab supplies.
Right, a one-stop shop.
Exactly. A one-stop shop for pretty much everything a lab might need.
Yeah.
Test tubes, complex reagents, you name it. But it's way more than just distribution. This segment also includes Patheon. That's their Contract Development and Manufacturing Organization, or CDMO. So imagine a pharma company, maybe a smaller biotech, right? They've got a great idea for a drug, but they don't have the massive setup needed to develop and make it.
Okay.
Patheon steps in. They act as their specialized factory and R&D partner, helping them navigate that whole complex journey from an idea to actually getting it to market. Then there's PPD, that's their Clinical Research Organization, or CRO. PPD manages human clinical trials, guides them through it, handles everything from finding patients to dealing with all the regulatory hurdles. It's incredibly complex work. Now, you might look at its operating margin, it's around 14%, which is lower than other segments.
Yeah, I noticed that.
Right, and that reflects how service-intensive and distribution-focused it is. But strategically, it's crucial. It gives them unparalleled customer access, deep integration. It's the entry point for so many customers, and those CRO and CDMO businesses, they are incredibly sticky. You're talking about being embedded in multi-year drug development cycles, clinical trials. That gives Thermo Fisher these long, predictable revenue streams that are really hard to disrupt. Customers don't just switch providers mid-trial.
That makes sense. Very sticky indeed.
Exactly. Okay, moving on, we have Life Science Solutions, or LSS. This segment is really their innovation engine, and interestingly, it's often their most profitable division. In Q2 2025, it had an impressive segment income margin near 37%, and it brought in 23% of their total revenue.
Wow, that's a big margin difference compared to LPS.
Huge difference, and it shows where a lot of the proprietary technology sits. LSS provides this vast, sophisticated portfolio of reagents, instruments, consumables, all crucial for every stage of science. Basic research, drug discovery, large-scale vaccine production, sophisticated disease diagnosis. LSS is involved. This is where you find key units like biosciences, genetic sciences, and bioproduction. Bioproduction is a world leader in single-use technologies. You know, those disposable bioreactors and tubing instead of the old stainless steel vats?
Oh, right. I've heard about those. Faster, more flexible.
Exactly. Revolutionized how complex biologics and vaccines are made. Faster, more flexible, more sterile. Big deal. And this LSS segment, particularly its testing kits and the inputs for vaccine production, this was the primary beneficiary of that massive demand during COVID-19. That absolutely explains why its profitability was so high during those years.
Okay, that connects the dots on the COVID boom.
Precisely. Next up is Analytical Instruments. AI, think of this as their capital equipment segment. It's about 16% of revenue with an operating margin around 19%. Still very healthy. This segment focuses on the really high-performance precision instruments, things like chromatography systems, mass spectrometers, advanced electron microscopes.
Stuff that sounds incredibly complex. What do they actually do?
Well, imagine trying to find one specific tiny impurity in a complex chemical mix, or trying to identify every single protein in a tiny biological sample, down to its exact atomic makeup. These instruments perform that kind of scientific magic, really. Unparalleled precision for research and quality control.
Okay, so high-end critical tools.
Very high-end. But the strategic importance of AI goes way beyond just selling the machine itself. Each instrument they place in a lab creates this powerful, long, predictable tail of high-margin recurring revenue. We're talking proprietary consumables needed to run it, specialized software licenses, ongoing service contracts.
The razor and blades again.
Exactly. And importantly, a lot of that recurring revenue from the consumables and services gets captured by the LSS and LPBS segments. It feeds the other parts of the ecosystem. Plus, their continuous innovation here, like the award-winning Orbitrap Astral Mass Spec, doesn't just attract new customers, it drives technology replacement cycles. Labs need to upgrade to stay competitive.
Keeps them at the cutting edge.
Definitely. And finally, we have Specialty Diagnostics, or SD. This accounts for just over 10% of revenue, but carries a very healthy 27% operating margin. SD focuses on providing essential diagnostic test kits, reagents, instruments used in clinical settings, hospitals, clinical labs, to improve patient diagnoses, guide treatment. This includes critical areas like immunodiagnostics, microbiology testing, identifying infectious diseases, and transplant diagnostics. Really important stuff. Their strategic acquisition of the binding site, for instance, significantly boosted their oncology portfolio, added specialized blood tests for diagnosing and monitoring certain cancers.
So tapping into major healthcare trends.
Precisely. It directly capitalizes on those powerful, durable trends like aging populations globally and the big push towards precision medicine, where diagnostics are absolutely key for tailoring treatments.
Wow, okay. That's an incredibly detailed breakdown of each piece. So when you put it all together, what does this truly tell us about how Thermo Fisher operates? How do these four sort of distinct but clearly complementary segments fit together to create such a powerhouse? It sounds, like you said, less like just a collection of businesses and more like a fully integrated scientific ecosystem.
Exactly. You've nailed the core of their genius. It is the ultimate industrial-scale, razor and razor blade business model, but it's got layers of complexity and synergy that make it profoundly effective. The initial sale of that high-performance instrument, that's the razor, right? It's a big capital investment for the customer. But its real purpose is to create this captive ecosystem. It locks that customer into years, maybe decades, of buying high-margin blades. We're talking proprietary consumables, essential software updates, critical service contracts, and this isn't just theoretical, the numbers absolutely prove it out. For fiscal year 2024, consumables brought in $17.59 billion, services brought in $17.85 billion. Together, that's over 82% of TMO's total revenue.
Over 82%, just from consumables and services.
Over 82%. Instruments, the initial razor sale, accounted for less than 18%, about $7.45 billion. It's a stark difference. And this incredibly high chunk of recurring revenue. It provides extraordinary stability to their top line. It gives them exceptional visibility into future performance, and it gives them significant pricing power. It basically acts as this powerful insulator, right? It cushions the business from the full blow of economic downturns that might make customers put off buying new big machines.
Because they still need the blades to run the razors they already have.
Yeah, precisely. Imagine that gold miner needing your specific brand of shovel, not just because it's good, but because all their existing gear, their training, their processes only work with your shovels. That's the kind of lock-in we're talking about. That's the reliability of that revenue stream. But the real magic, as you hinted, is that integrated ecosystem. LPBS, with its huge logistics network and direct customer ties, acts as the main channel. It distributes the high-margin LSS consumables and the AI segment's equipment. Then, in turn, that enormous installed base of AI instruments drives the continuous, predictable demand for those LSS consumables. It's a perfect circle.
Virtuous cycle.
A virtuous cycle, exactly. This seamless integration creates that formidable one-stop shop advantage. It makes TMO indispensable to customers and, crucially, builds extremely high barriers for competitors trying to break in. And that difference in margins we talked about, the lower margins in LPBS compared to the high profitability in LSS and SD, that's not a flaw, it's a deliberate strategic design. LPBS secures the broad customer relationships and provides the operational scale needed to support and amplify the profitability of those innovation-driven, higher-margin segments. When you look at the overall company operating margin, you see the powerful synergy. You see the true effectiveness of this interconnected model. It's a masterful balancing act, really, that creates immense value.
That's a brilliant explanation of the internal workings. Truly brilliant. Now, let's zoom out a bit. Let's look at the external forces. This is where it gets really interesting, I think, exploring the huge market Thermo Fisher operates in and, just as vital, who their main rivals are in this incredibly dynamic space.
Yeah, we're talking about the global life sciences tools and diagnostics market, and it is genuinely massive and growing rapidly. TMO's own management puts their total addressable market, or TAM, at around $235 billion, and they see long-term growth of about 4% to 6% a year. Solid. However, it's worth pointing out, independent industry reports often paint an even more robust picture. Some analyses put the market somewhere between, say, $123 billion and $168 billion in 2023-2024, but they forecast it could explode at a compound annual growth rate, AEGR, of 10-13% to potentially top $470 billion by 2034.
Wow, that's a huge difference from management's 4-6%. Why the gap?
Yeah, it is significant. Likely comes down to how you define the market, what gets included, or maybe it's just some strategic conservatism from management in their public guidance. Could be either. But regardless of the exact numbers, the underlying trend is undeniable. This industry is propelled by several really powerful, enduring secular growth drivers that are just gaining steam. First, biopharmaceutical R&D investment. It's not just strong, it's booming. The global pipeline of new drugs, especially complex things like biologics, and totally new approaches like cell and gene therapies, they demand increasingly sophisticated, high-throughput, often very expensive tools and manufacturing inputs.
So more research means more need for their stuff.
Exactly. It creates this sustained foundational demand for TMO's entire portfolio, from the earliest discovery work right through to commercial production. It's like this perpetually expanding frontier needing new and better gear. Second, the rise of precision medicine. This global shift towards personalized, targeted therapies is accelerating. And this requires advanced genomic tools, proteomic tools, diagnostic tools to identify biomarkers, stratify patients accurately, guide those really individualized treatments. For Thermo Fisher, this means direct, powerful tailwinds for their analytical instruments and specialty diagnostic segments. They're right at the forefront.
Makes sense. More targeted medicine needs better tools to target.
Precisely. Third, we have favorable demographics and increasing global healthcare demand. An aging global population just inherently leads to more chronic and complex diseases, which in turn drives greater demand for diagnostic testing and the development of new therapies. This benefits every single one of TMO's segments. It's almost a demographic certainty, providing a long-term demand floor. And finally, a huge growth frontier is expansion in emerging markets. We're seeing significant increases in healthcare spending, government investment in life sciences research, and a growing middle class with better healthcare access in places like Asia Pacific. That market's projected to be the fastest growing globally. Some forecasts see a potential CGR up to 15%. That's a massive long-term opportunity, even with the complexities involved.
So strong underlying drivers. Is the industry immune to economic ups and downs?
Broadly resilient, yes, but not totally immune. That's important. Demand can correlate with R&D budgets of pharma and biotech companies and government funding levels. So, for example, if biotech funding gets cautious, like we saw recently, companies might delay buying big new equipment or slow down early research. However, and this is key, Thermo Fisher's business model, with that huge reliance on non-discretionary recurring consumables, provides a substantial cushion. Labs simply can't stop running tests or growing cells, so they keep ordering those blades even if they hold off on a new razor. This built-in stability makes them far less volatile than many other industries.
Okay, that gives a really clear picture of the market's strength and potential. But in this huge, growing landscape, who are the main players TMO is actually competing against? They can't be the only giant out there.
No, definitely not. You're right. This market, despite its size, it really favors a consolidated top tier of large diversified players. And Thermo Fisher is at the very top. But they face some very formidable rivals. Danaher, DHR, is arguably Thermo Fisher's most direct and formidable competitor. Full stop. They run a remarkably similar multi-segment model, deep focus on life sciences, diagnostics, biotech. And Danaher is famous for its intense operational rigor, much like TMO, driven by their own proprietary system, the Danaher Business System, or DBS. For fiscal 2024, Danaher reported revenues around $24 billion. So clearly a huge, persistent presence. They are absolutely a force.
Okay, so Danaher's the big one. Who else?
Then there's Agilent Technologies, They're a major competitor, especially strong in analytical instruments, leading positions in things like chromatography and mass spectrometry. Agilent's revenues were about $6.5 billion in fiscal 2024. Shows their specialization and reach in those core areas. In clinical diagnostics, global giants like Abbott Laboratories, ABT, and Roche Diagnostics are tough challengers. They go head-to-head with TMO's specialty diagnostics segment. Just Abbott's diagnostics division alone brought in $9.34 billion in fiscal 2024 revenue. That highlights the intense competition and the sheer size of that diagnostics market.
Huge numbers.
Huge. And finally, Illumina, ILMN. They are the undisputed leader in next-generation sequencing, or NGS. That's a rapidly advancing field that competes directly with parts of TMO's genetic sciences business. While Illumina's 2024 revenue was smaller, around $4.3 billion, their technological leadership in that specific high-growth niche is undeniable. They own that space right now. But when you analyze Thermo Fisher's overall position, the picture is clear. They consistently hold the number 1 or number 2 spot in the vast majority of categories they compete in. They are the largest player overall by revenue, and their dominance in distribution is particularly stark. One analysis estimated they command a staggering 57.3% market share in U.S. laboratory supply wholesaling through Fisher Scientific.
Over half the market,
Correct.
just for lab supplies in the U.S.
Over half. It's incredible market penetration. Think about that leverage. So the key takeaway here is the overwhelming scale advantage. The sheer complexity of the life sciences industry, from basic research to commercial manufacturing and diagnostics, it inherently favors players with scale and a broad portfolio. Big customers, multinational pharmas, major research institutions, they increasingly want to consolidate suppliers. They want simpler procurement, guaranteed compatibility across sites, better efficiency from dealing with fewer vendors.
Makes sense for them. Easier to manage.
Exactly. And this dynamic creates that powerful virtuous cycle for players like Thermo Fisher and Danaher. Their huge scale lets them offer a broader, more integrated portfolio, which attracts more big customers, which deepens those relationships, which further enhances their scale, making it incredibly hard for smaller niche players to really challenge them. It's a self-reinforcing advantage.
That really paints a vivid picture of their command. Given that complex ecosystem and their market dominance, it totally makes sense they'd have strong defenses. So let's really dig into why TMO is so dominant. What are those unshakable competitive advantages, their moats, that protect this massive business and make it so resilient even when things get tough?
Yeah, the concept of a competitive moat is absolutely crucial here, and Thermo Fisher has built a fortress of them. Durable, mutually reinforcing advantages that protect their profits and market share. These aren't just isolated strengths either, they work together, creating this almost impenetrable position. First and foremost is just their unmatched scale and global reach. Over 125,000 employees, this enormous operational footprint all over the globe. Their sheer size, arguably their single biggest advantage, and this gives them tangible benefits. Superior purchasing power with their own suppliers, massive logistical efficiencies few can match, and what they rightly call an unparalleled commercial engine for accessing customers worldwide. This global reach is absolutely critical for serving those big, multinational pharma and biotech clients who need seamless service, consistent products, technical support across all their sites wherever they are. Imagine trying to replicate that quickly. It's practically impossible.
The logistics alone must be incredible.
Incredible. Second, they benefit from remarkably high customer switching costs. TMO isn't just selling stuff. They are deeply integrated into their customers' critical everyday workflows. When a lab invests heavily in a big analytical instrument like one of their advanced mass specs, it's not just buying a machine. That purchase usually locks them into a multi-year relationship because they then need the compatible proprietary consumables to run it, and their staff get extensive specialized training just on that platform.
Right, you're invested in the whole system.
Totally invested. Think about the huge cost and time involved if they decided to switch to a competitor. They'd have to revalidate countless processes, rewrite all their standard operating procedures, SOPs, retrain their entire staff. These are monumental barriers to leaving. It creates extremely sticky customer relationships and really cements TMO as a trusted partner, not just a vendor. And this leads right into their vast installed base. That huge network of instruments already out there in labs globally under big brands like Thermo Scientific, Applied Biosystems, and Vitrogen, it acts like a perpetual annuity. Every instrument generates this continuous, highly predictable stream of high-margin, recurring revenue from consumables, software licenses, service contracts for years, sometimes decades.
It's like a gift that keeps on giving, financially speaking.
Exactly. A powerful revenue flywheel that just keeps spinning, provides exceptional revenue visibility and stability. Then there's the relentless commitment to R&D and high-impact innovation. TMO isn't just sitting back collecting consumables revenue. They're consistently pushing the boundaries. They invest a lot in R&D, over $1.3 billion on a last 12 months basis as of Q2 2024. This fuels a strong pipeline of new cutting-edge products. That attracts new customers, yes, but it also drives essential technology replacement cycles and expands their market opportunities. Think about recent launches like the Orbitrap Astral and Stellar Mass Specs, revolutionizing proteomics research by letting scientists see proteins with unprecedented speed and depth, or the Ion Torrent Genexus platform for NGS, making genomic analysis faster, more accessible. That's their innovation engine running full tilt.
So, constantly creating the next must-have tool.
You got it. Now, a critical and maybe often underestimated moat is their proven M&A and integration capabilities. Thermo Fisher has an incredible track record of successfully doing and crucially integrating acquisitions. This isn't just part of their growth plan, it's a deeply ingrained, well-honed corporate skill. We've seen it from small tech bolt-ons to those truly transformative multi-billion-dollar deals like Life Technologies, Patheon for CDMO, and PPD for CRO services. They don't just buy companies, they expertly fold them into their system and extract value. It's impressive.
That integration piece sounds key. Lots of companies make acquisitions, but making them work is another story.
Absolutely. And that brings us to another fundamental pillar, their practical process improvement, PPI, business system. This is very much like Danaher's famous DBS. It's a deeply ingrained culture of continuous improvement woven through the whole organization. Management consistently credits PPI with driving outstanding operational execution, boosting productivity and quality everywhere, and critically, providing the standardized playbook that makes integrating all those acquired companies successful. This operational excellence is a key differentiator, a hard-to-copy intangible asset. It's kind of their secret sauce for consistent performance. And lastly, their strategic geographic presence and focused investment in emerging markets is another moat. They're strong in North America and Europe, sure, but they've strategically and aggressively invested in high-growth emerging markets, especially Asia-Pacific. That market's expected to grow at maybe 15% DBAGR. They're actively setting up new customer solution centers in key Asian hubs to capture this boom. Now, this global diversification does expose them to geopolitical risks, which we should talk about, but it also significantly broadens their addressable market and long-term growth potential.
That's a really powerful list of interconnected strengths. So what does it all mean when you combine that M&A skill with the PPI system? It sounds like they're not just separate advantages, they actually feed each other in a really powerful way. And you mentioned a data advantage. Can you expand on that? That sounds like a very modern kind of moat.
Absolutely. You've hit a critical synergy there. The PPI system is precisely what de-risks M&A so effectively for them. It provides that rigorous, standardized framework for integrating new businesses. It lets them systematically find and pull out costs and revenue synergies and make sure the acquired company's operations quickly align with TMO's culture of efficiency. This institutional skill in buying and improving businesses gives management the confidence to go after big, complex deals that might just overwhelm other companies. It makes M&A a cornerstone of their long-term value creation and a clear competitive edge. And regarding that data advantage, it's truly unique. By serving customers across that entire research clinic continuum with such an unparalleled breadth of tools, software, services, Thermo Fisher gets this amazing, almost real-time view into the evolving needs of the whole life sciences industry. Think about the sheer amount of data generated from customer interactions, sales trends, tech support questions, how products are actually being used. It provides invaluable intelligence.
So they can see trends before almost anyone else.
Pretty much. They see emerging tech trends, new scientific breakthroughs brewing, critical customer pain points. This data lets them strategically shape their internal R&D priorities, target M&A opportunities with incredible precision, and essentially anticipate market shifts. It allows them to put capital into the most promising areas maybe before competitors even fully spot the opportunity. It's like having a highly sophisticated crystal ball, but one powered by deep scientific insight and vast commercial intelligence.
That's an exhaustive and really compelling look at their strengths. Now let's shift to the numbers. Let's dive into what all this translated to for TMO's financial performance, especially through those seismic shifts of the last few years, which for many companies felt like an absolute financial roller coaster.
Roller coaster is definitely the right word, particularly when you look at the dramatic arc of TMO's revenue and earnings growth from, say, 2019 to 2024. This period really shows that extraordinary and largely one-time growth fueled by the pandemic, followed by a necessary, and I'd argue predictable, period of normalization as those huge tailwinds faded. Let's set the scene first with the pre-COVID baseline in 2019. This shows a company already doing really well, strong, stable growth. Revenues were $25.54 billion, up a solid 5% year over year. Adjusted earnings per share, EPS, was $12.35, up a healthy 11%. This is kind of that robust mid to high single-digit organic growth you'd expect from a leader in this space.
Okay, so strong even before the pandemic boost.
Exactly. Then came the pandemic-driven peak in 2020-2021. COVID was just this enormous, unprecedented catalyst for them. Revenues surged, really surged, by 26% to $32.22 billion in 2020. Then another 22% jump to $39.21 billion in 2021. This wasn't just normal growth. It was fueled by billions in COVID-19 response revenue, primarily from their PCR testing products, which were in huge demand, and essential services supporting vaccine and therapy manufacturing. Adjusted EPS mirrored this explosion, grew dramatically to $19.55 in 2020, and peaked at an impressive $25.13 in 2021. For TMO, the pandemic was a demand event, unlike almost anything else.
Just incredible numbers during that peak.
Absolutely. Now, for the inevitable post-COVID normalization, 2022-2024, as that pandemic demand naturally subsided, the company entered this recalibration phase. Revenue actually peaked at $44.92 billion in 2022, then declined slightly to $42.86 billion in 2023. But that headline drop was largely because those massive COVID revenues just plummeted from over $9 billion in 2021 down to only $330 million in 2023. Huge drop-off. Consequently, adjusted EPS moderated from its peak, fell to $23.24 in 2022, then $21.55 in 2023. However, and this is really crucial, you have to look beyond those headline declines, their core organic revenue, which strips out the distorting effects of the pandemic stuff, actually stayed positive through this whole period. It showed a respectable 1% growth in 2023.
So the underlying business was still growing, just masked by the COVID drop-off.
Yeah.
Precisely. For the full year 2024, the company reported revenues of $42.88 billion and adjusted EPS of 21.86. That indicates things stabilizing as they exited that really volatile period. And looking ahead to 2025, management guided for a return to more normal 3% to 6% organic revenue growth, which is much more in line with long-term industry trends. Let's also look closely at the margin analysis during this time because that dramatic shift in revenue mix really impacted profitability. Adjusted operating margins were healthy at 23.4% in 2019. They expanded significantly to a peak of 31.0% in 2021.
31%. Wow.
Yeah, that was directly because of the exceptionally high margins on those COVID-19 testing products. Huge demand, premium pricing. As that high margin revenue rolled off, margins naturally compressed, declined to 24.5% in 2022, 22.9% in 2023, and sitting around 21.9% in Q2 2025.
So a key question for investors now is,
Right.
what is the new sustainable margin level for this business post-pandemic and post that big PPD acquisition? It's a fundamental re-rating question.
Makes sense. The profile of the business changed. It really did. But on a decidedly positive note, Thermo Fisher consistently proves itself to be a prolific cash flow generator. Just prints cash. Free cash flow was $4.1 billion back in 2019. It surged during the pandemic and was reported at a robust $7.3 billion for fiscal 2024. This incredibly strong cash generation gives them ample capacity to fund their organic growth, service their debt comfortably, and execute their disciplined capital deployment strategy. And the balance sheet looks notably healthy. Yes, total debt increased to about $35 billion, largely to fund big acquisitions like PPD, but their debt-to-equity ratio of around 0.7x is very manageable, extremely well supported by those strong, predictable cash flows. Shows a prudent approach to leverage.
That's a very clear analysis of the dynamics. The headline numbers definitely tell a dramatic story, but it sounds like the real underlying story is hidden in that core organic revenue growth. So what's the single most important takeaway from this whole financial roller coaster for someone trying to understand TMO's true health right now?
Yeah, if we connect this to the bigger picture, the absolute key takeaway is this. You must look past those heavily distorted headline revenue and earnings figures from 2020 to 2023. Those were shaped by the unique, one-time nature of pandemic demand. That core organic revenue growth figure, that's the true indicator of the underlying business's resilience. It unequivocally shows the base business kept growing even as that massive COVID tailwind reversed into a pretty significant headwind. So the primary analytical challenge now for anyone modeling the company is to accurately figure out and project that new normalized baseline for revenue and profitability. That's how you get a clear picture of future performance. And furthermore, we can't ignore the significant financial impact of that $17.4 billion PPD acquisition, which closed late 2021. Bringing in this huge clinical research organization which operates with an inherently different service-based financial model, typically lower margins than some of TMO's product divisions that also contributed to the structural reset in the company's overall margin profile.
Right. Adding a big service business changes the mix.
Exactly. So the long-term success of that transformative deal, it'll be measured by management's ability to drive substantial revenue synergies, cross-selling services and products, and to effectively apply their PPI system to boost PPD's operational profitability over the coming years. It's definitely a complex picture, no doubt, but one that ultimately shows the underlying business emerging stronger, albeit with a new financial architecture.
That's a crucial distinction, focusing on core organic growth versus the pandemic noise. But the past few years weren't just about COVID, right? What new, maybe more persistent challenges has TMO faced recently? And are there signs they're successfully navigating what you call this transitional period?
Yeah, it's been a fascinating time, marked by a real confluence of macroeconomic and industry-specific challenges, no doubt about it. And management's navigation through this is absolutely key for investors, for understanding where they're headed. The most prominent ongoing headwind has still been the COVID-19 impact normalization. This factor lingered right into 2025. Management specifically called out a 1% headwind from the runoff of this revenue in the Q2 growth figures. Think of it like a space shuttle shedding a booster rocket after launch. It's a necessary stage, but it impacts the immediate speed. So the strategic imperative for TMO is clear. They have to accelerate growth in their core business to fully offset this declining COVID revenue and get back to a normalized, predictable growth path driven by underlying market demand.
Makes sense. Got to replace that loss boost.
Exactly. Another significant and increasingly complex challenge has been China market dynamics. China is a huge market for Thermo Fisher, a big chunk of their international revenue. But in Q2 2025, revenue from China actually declined in the high single digits. That's significant.
Ouch, why that skull line?
It seems to be a mix of things. Broad macroeconomic pressures within China, softer demand, industrial output slowing down, and the persistent impact of the U.S.-China tariff situation. It's a notable drag on their overall growth. Now, in response, management is actively using their PPI system to reconfigure supply chains, adapt to the new trade realities, aggressively manage costs to soften the blow. Interestingly, management also noted that the actual impact from tariffs in Q2 was less severe than they'd initially baked into their forecast. That actually helped them beat organic revenue expectations and suggests their public guidance might be a bit conservative.
Maybe building in some cushion?
Could be. But this whole situation raises that important question for any global company, right? How do you balance the huge growth opportunities in markets like China with the increasing geopolitical risks, where the rules can just shift so quickly? It's a delicate, ongoing tightrope walk for them. Perhaps the most closely watched area by analysts and investors has been the bioprocessing market environment. This is a key, high-margin part of their life sciences solutions segment. It went through a significant slowdown in 2023 and early 2024. Largely due to a more cautious funding climate for emerging biotech companies, they pulled back on R&D spending and also widespread inventory destocking. Customers had basically overordered during the pandemic peak and were working through that excess inventory. It was a tough patch.
Right, the inventory overhang issue.
Yeah, exactly. However, we're now seeing some really encouraging commentary that suggests a potential inflection point, a turning point. In Q2 2025, management specifically highlighted strong performance in their bioproduction business. It delivered mid-single-digit growth and, importantly, reported excellent bookings growth. These positive signs, especially the strong forward-looking bookings, which is a leading indicator for future sales, could strongly signal that the worst of that destocking cycle is indeed over, and that the broader biotech market is starting to find its footing again.
That sounds like potentially very good news.
Potentially very good news. And finally, the broader supply chain and regulatory environment remains complex. Persistent geopolitical trade tensions, the ripple effects of the past few years, it's still challenging. Thermo Fisher is constantly using its huge scale and the adaptability of its PPI system to manage these disruptions, control costs across its global network. On the regulatory side, they've consistently shown a pragmatic, effective approach. For instance, strategically tweaking the scope of a planned acquisition to get faster regulatory clearance. That shows real agility in navigating external hurdles.
That positive commentary on the bioprocessing market really jumps out at me. It sounds like a crucial signal, maybe not just for TMO, but for the whole industry. How significant is that, really?
It is immensely significant. You're right. The bioprocessing market is widely seen as a bellwether for the entire biotech and biopharma industry. Why? Because it directly reflects the health and activity levels of drug development and manufacturing pipelines. So Thermo Fisher is seeing strengthening demand and critically robust bookings growth in this area. That could be a very powerful leading indicator of a broader recovery across the whole sector. A sustained rebound in bioprocessing would be a truly powerful catalyst for reaccelerating revenue growth and, importantly, expanding margins for Thermo Fisher late in 2025 and well into 2026. It's arguably the key data point right now suggesting the company is indeed moving through this transitional period and, rather than just emerging, potentially poised to reaccelerate and really thrive again.
Okay, so despite these complex challenges and this transitional phase we've talked about, where does TMO see its biggest growth coming from? What's the strategic playbook look like for the future for a company with this kind of scale and market leadership?
Yeah, TMO is definitely not a company sitting still. They are strategically positioned to capitalize on numerous powerful long-term growth opportunities. And it's driven by a smart mix of organic innovation, focused geographic expansion, and that disciplined approach to strategic acquisitions. Their future playbook seems pretty clear. A major strategic focus is expansion in high-growth fields. Take cell and gene therapy, for example. That's a rapidly expanding frontier in medicine. These therapies need highly specialized manufacturing, complex production of things like viral vectors, advanced cell culture media. Thermo Fisher has aggressively built out its capabilities here, both internally through R&D and strategically through acquisitions like Brammer Bio. They've become a leading CDMO partner for these therapy developers. Think about how fundamental that is for the next wave of potentially curative medicines.
Positioned right where the science is headed.
Exactly. Similarly, the accelerating shift towards precision medicine and proteomics is a huge driver. Personalized medicine needs ever more advanced analytical and diagnostic tools to understand individual patient biology. TMO is a global leader in mass spectrometry, a core tech for proteomics, which is essential for finding new drug targets and diagnostic biomarkers. Their recent strategic acquisition of Olink, a leader in advanced proteomic solutions, significantly strengthens their position in this high-growth field, really expands their toolkit in this crucial area of discovery. They're also heavily focused on geographic expansion in emerging markets. North America and Europe are still their biggest revenue bases, sure, but they see huge long-term potential in regions like Asia-Pacific. Countries like China and India are investing heavily in healthcare infrastructure and biopharma R&D. TMO is actively expanding its commercial and manufacturing footprint in these regions to capture that growing demand, though, as we discussed, this comes with those geopolitical risks that need careful handling.
Balancing act there.
Definitely. Digital transformation and informatics is another key investment area. They're increasingly using advanced digital tools and data analytics to boost their value to customers, developing sophisticated software to control instruments, analyze huge scientific data sets, and also internally using AI within their PPI business system to streamline processes, enhance customer service through predictive analytics, cut operational costs further. It shows a real commitment to tech leadership, not just in products, but in how they operate. And of course, market share gains and their acquisition strategy remain absolutely central. Their sheer scale, comprehensive portfolio, reputation, it naturally positions them to keep taking share from smaller competitors. And their proven M&A engine is a core pillar of growth. Management's constantly looking at targets to fill portfolio gaps, enter new adjacent areas, enhance tech capabilities. The critical factor here, again, is that their PPI system ensures successful integration and value creation from these deals. It allows them to pursue complex acquisitions with more confidence.
It really does sound like M&A is just part of their DNA, like a well-oiled machine itself. How does TMO actually decide where to put its substantial capital to fuel all this growth, especially with that intense acquisition focus?
It's a very disciplined and, frankly, quite transparent capital allocation strategy. Historically, their long-term target allocates about 60–75% of capital to strategic M&A. The other 25–40% goes to returning capital to shareholders. To give you a concrete example, in 2024, they deployed a huge $7.7 billion of capital. $3.1 billion of that went specifically to buy Olink, and $4.6 billion was returned to shareholders through dividends and share buybacks. So it's a balanced approach. Robust investment in future growth, but also consistent direct returns to shareholders.
M&A clearly gets the lion's share, though.
It does. As you said, M&A is a true cornerstone. They have a long, incredibly successful history. From those transformative deals like Life Technologies, Pantheon, PPD, which fundamentally reshaped the company into more strategic bolt-ons like the binding site for oncology, Olink for proteomics, which adds specific tech and high-growth niches. The rationale is always consistent. Buy high-quality assets in attractive markets where Thermo Fisher can uniquely leverage its scale, its global commercial engine, and that PPI system to create significant value. In terms of dividends and share repurchases, they have a consistent policy of paying and growing their dividend. They've raised it for 7 consecutive years now. That signals strong management confidence in their ongoing cash flow generation. The yield might be modest given the stock price, but the focus is on consistent growth. Share buybacks are their main way of returning the majority of capital, and management has shown they're willing to be opportunistic, aggressively buying back shares when they think the stock is undervalued. That flexibility lets them enhance shareholder value effectively.
And who's actually steering this ship through all these complex decisions, the strategic plays, this dynamic global landscape? Let's talk a bit about the leadership behind Thermo Fisher.
Yeah, the exceptional strength and consistency of TMO's execution, you can largely attribute that to its highly experienced and long-tenured management team. Mark N. Casper, the chairman, president, and CEO. He's led TMO as CEO since 2009, been with the company since 2001. He is widely regarded as one of the most effective leaders in the entire healthcare sector. He's overseen this massive transformation into the undisputed industry leader through that mix of strong organic execution and those highly successful transformative acquisitions we keep mentioning. His steady hand is really central.
Long tenure, clear track record.
Exactly. And the broader executive team is made up of seasoned industry veterans with deep expertise in their areas. Their strategic vision is clear, it's consistent. The long-term target is ambitious, sure, 7% and 9% organic revenue growth, mid-teens adjusted EPS growth, but it's seen as achievable. And this vision rests on 3 core pillars. First, delivering high-impact innovation. Second, deepening their status as the most trusted partner to their customers. And third, leveraging that unparalleled commercial engine to keep gaining market share. And all of this execution, as we've highlighted multiple times, is powered by that essential PPI business system. In terms of corporate governance, it looks robust. The board has a majority of independent directors, key committees are fully independent. Management also maintains a high degree of transparency through detailed reports, investor calls, and their financial guidance has historically been viewed as highly credible. In fact, recent commentary, as we noted, suggests maybe a degree of conservatism in their guidance, particularly on China, which could potentially set them up for outperformance later. It really seems like a well-oiled machine, led by a highly respected and effective team.
Okay, so for those listeners who might be thinking about TMO as an investment, what does the market actually say about its value right now? And maybe more importantly, what are the potential pitfalls? Even for a company this strong, this seemingly indispensable, there must be risks, right?
That's an excellent and crucial question. You absolutely have to look at both sides of that coin. Thermo Fisher consistently trades at a premium valuation, no doubt about it. And that strongly reflects its status as this high-quality, wide-moat market leader with a robust, predictable growth profile. So as of early September 2025, let's look at some key valuation metrics. The stock's trading at a trailing 12-month price-to-earnings, or PE ratio, of about 28.0x. Its enterprise value to EBITDA, which includes debt for a broader view, is around 18.8x. And its price-to-sales ratio is about 4.3x.
Okay, so what do those numbers actually tell us? Is 28x PE high, low, average?
Well, a PE of 28x means investors are willing to pay $28 for every dollar of the company's annual earnings. That suggests pretty strong expectations of consistent, high-quality earnings growth going forward. Now, putting that in historical context, the current PE around 28s is actually within its long-term historical range. It's below the peak multiples we saw during the pandemic growth spurt. So the normalization of earnings post-COVID has brought the multiple back to more typical, though still premium, levels. Now, let's compare it to its peer group. Danaher, DHR, its closest rival, trades at a significantly higher TTM PE of about 43.7x and an EBITDA around 21.7x.
That's much higher for Danaher.
Much higher. That premium might reflect slightly higher perceived growth in certain areas for Danaher, or maybe just a different point in its earnings cycle. Agilent A trades at a comparable TTM PE about 29.5x, which is interesting because Agilent historically has had somewhat slower growth, lower margins than TMO, might indicate the market values its stability. Illumina, ILMN, is way lower, PE around 12.7x. But that really reflects significant company-specific problems they're having, making it less of a direct comparison for a quality leader like TMO right now. So this comparison suggests that while TMO's valuation isn't cheap in absolute terms, it looks pretty reasonable relative to its closest high-quality peer, Danaher, and maybe even attractive compared to Agilent, given TMO's superior fundamentals.
So the premium seems justified by its quality.
That's the argument. This premium valuation is robustly supported qualitatively by several core factors we've discussed. The defensive end markets healthcare research don't just stop. That incredibly high recurring revenue from consumables, its strong reinforcing moats, and that proven decades-long track record of execution and value-adding capital allocation. Simply put, it's less cyclical, more consistently profitable than the average S&P 500 company. That fundamentally justifies a higher multiple. Now, while a formal discounted cash flow model is complex, conceptually, TMO's valuation is highly sensitive to certain key factors. Things like the long-term revenue growth rate, if they hit their 7-9% target versus a lower 4-6% market rate, that significantly impacts intrinsic value. Achieving sustainable operating margins moving from 22% now towards our 23-25% target. And the discount rate used influenced by things like treasury yields and risk premiums. Also, while you could do some of the parts analysis and argue the higher margin LSS and SD segments deserve higher standalone multiples, that approach risks undervaluing those powerful synergies between all the integrated segments. Ultimately, the valuation seems fair for a best-in-class compounder, provided management successfully navigates the current headwinds and delivers on those long-term targets.
That's a very thorough look at the valuation side. Which brings us to the flip side. This raises that important question. What are the potential stumbling blocks? The hidden vulnerabilities, even for a company this strong, this dominant. No business is truly risk-free after all.
Absolutely true. And it's essential for anyone looking at this company to be aware of these risks. Even with robust moats, an investment in Thermo Fisher carries several key risk factors. First, there's cyclical and funding exposure. Resilient, yes, but not totally immune to economic cycles. A significant chunk of their revenue, especially for new big equipment, is tied to R&D budgets, pharma, biotech, academic institutions. A prolonged downturn in biotech financing, like we saw pockets of recently, or significant sustained cuts in government research funding, like NIH budgets, that could lead to deferred equipment purchases, reduced demand for consumables, and hurt their growth.
So, dependent on overall research spending.
To a degree, yes. Second, geographic and geopolitical risk. Very real, increasingly prominent. China isn't just a big market, it's a key growth driver. But escalating trade tensions, more tariffs, policies pushing for domestic localization of equipment, that could significantly impact revenue and profit there. The recent high single-digit decline in China shows this is a tangible risk, not theoretical. It can bite quickly. Third, competitive pressures are intense. This industry is highly competitive. TMO faces formidable rivals like Danaher, which also has a powerful operating system. The risk of pricing pressure, especially in more commoditized areas, is always there. Plus, the threat of technological disruption from an existing competitor or a new entrant with a breakthrough could erode market share in key lines. Think about the rapid innovation pace in genomics or single-cell analysis. A game changer could shift the landscape.
Always looking over their shoulder.
Have to be. Fourth, M&A integration risk. Can't ignore it. TMO's growth relies heavily on M&A. While their track record is excellent, there's always a risk a future large acquisition, maybe one bigger or more complex than before, could be poorly executed. That could mean failing to get expected synergies, culture clashes, operational disruptions. A bad major acquisition could be a significant drag on performance and management focus. Fifth, regulatory risk. They operate in a highly regulated industry globally. Changes in healthcare regulations, especially around diagnostic test approvals or reimbursement in the US and Europe, could really impact their specialty diagnostics growth and profitability. Also, changes in international trade rules, tariffs, often unpredictable, are a persistent risk to their complex global supply chain and overall profitability. And finally, technology risk. Life sciences moves incredibly fast. TMO is a leader in innovation, yes, but there's always a risk a competitor develops a truly disruptive new technology, maybe a radically cheaper, faster gene sequencer, or a totally new proteomics platform that could make part of TMO's huge portfolio obsolete or much less competitive. That would require big, costly investment to catch up or buy the new tech. The pace of science is both a tailwind and a potential risk.
Okay, that's a crucial and comprehensive list of risks to balance against those immense strengths we've discussed. So to bring this all together, let's try to address some of the most pressing questions for TMO right now, especially after everything we've unpacked about its structure, its market, its financials, and its future.
Absolutely. These are the critical questions that really define the ongoing story for Thermo Fisher in this dynamic, evolving environment. First one, how sustainable is TMO's revenue growth as those COVID tailwinds fully normalize? The evidence strongly suggests their underlying growth is fundamentally sustainable, but it'll certainly be at a more moderate pace than those crazy headline numbers from 2020, 2021. Management's long-term target of 7-9% organic growth, it's ambitious, no doubt, but it seems achievable if they keep gaining market share and capture outsized growth in those high-impact areas like bioproduction and precision medicine. The recent positive signs in bioprocessing recovery, that's a very good leading indicator. But ultimately, hitting that growth target still depends heavily on the sustained health of biopharma funding and the macro conditions in key markets like China.
So sustainable, but ambitious, depending on external factors.
Pretty much. Second, can the company maintain its premium valuation multiple through the current cycle? Maintaining that premium valuation requires continued strong execution. Simple as that. If TMO successfully navigates these current headwinds, shows a clear bottoming and reacceleration in key markets like bioprocessing in China, and shows consistent progress on stabilizing and expanding margins, then the market will likely keep awarding them that premium multiple for being best in class, for that compounding ability. Failure to deliver on those fronts, or a long period of sluggish growth, that could definitely lead to multiple compression as investors rethink their growth prospects. Execution is key. Third, how effectively is management navigating those China market challenges? Management's approach seems both proactive and effective, operating skillfully within the constraints of a tough macro and geopolitical situation. Their commentary suggests a conservative approach to guidance, while they're actively using PPI to mitigate impacts through supply chain tweaks and tight cost controls. That operational agility is a major strength. However, you have to acknowledge they remain inherently exposed to significant external macro and geopolitical risks there that are largely outside their control. So it will remain a very closely watched area.
Proactive, but still vulnerable to external shocks.
Exactly. Fourth, what is the realistic timeline for margin recovery? A return to those peak 30% plus adjusted operating margins from the pandemic. Frankly, highly unlikely. The structural normalization of revenue, mix away from high-margin COVID tests and bringing in the lower-margin PPD services business, have structurally reset their margin profile to a new baseline, a realistic scenario. Probably a gradual, steady recovery from the current 22% level towards a sustainable range of 23–25% over the next, say, 2 to 3 years. This will mainly be driven by operating leverage from renewed core revenue growth, ongoing cost savings from PPI, and realizing synergies from those big recent acquisitions. Slow and steady improvement is likely the path. And finally, how does TMO's competitive position compare to 5 years ago? Arguably, Thermo Fisher's competitive position is even stronger today than 5 years ago. Through those transformative acquisitions of PPD and Patheon, they've significantly expanded their value proposition. They've evolved from mostly a tools and consumables seller into a true end-to-end strategic partner for the whole biopharma industry, from early research right through clinical trials and manufacturing. This deeper integration into the customer value chain has substantially widened their competitive moat and significantly enhanced their long-term growth prospects despite the near-term financial complexities these huge deals introduced. They've become even more indispensable, you could argue, to the global scientific enterprise.
So what does this all mean for us? We've really gone on a comprehensive deep dive today, haven't we? Unpacking how a company like Thermo Fisher Scientific operates, how it innovates, how it strategically positions itself in a world that's changing so fast, scientifically and geopolitically. It really is a masterclass in adaptation. TMO stands as this resilient, indispensable giant, clearly riding powerful long-term growth trends in healthcare and life sciences. Yet it's also currently navigating this complex period of pandemic normalization, these tricky geopolitical shifts. It's a company that genuinely underpins global scientific progress, a quiet powerhouse that we all implicitly rely on, whether we realize it or not.
Yeah, and if we connect this to the bigger picture, maybe a final thought for you to mull over. Think about how Thermo Fisher's story really highlights that delicate but absolutely crucial balance between global integration on one hand and regional vulnerabilities on the other, especially in essential industries like this. How might its strategic shifts, managing global supply chains, investing in R&D in emerging markets, how might that not only secure its own future, but also profoundly influence the broader landscape of scientific innovation and healthcare access around the world for decades to come?
Wow.
What ripple effects might we see from its ability, or perhaps its inability, to perfectly execute that balance in an increasingly complex and interconnected world? It's a compelling thought, I think, for anyone interested in global health and the very future of science itself.